Okay, folks, welcome back. I know it's been a long break between the last time I did the responses, but we haven't really received that many more questions. So um, this one here is from Christian, and I've already read your post here. And to answer your question, before I do anything more, I highlighted an area in your response that I feel is very, very, very important to have as a part of your trading plan. If you're not taking into account for a higher time frame bias, that's going to be problematic. Okay, so when I see stuff like that, it makes me cringe. You have to always have that in the forefront of your mind while you're doing something. Okay, otherwise you're not going to know if the trade that you're taking is a low resistance liquidity run. Okay, because that's what makes a low resistance liquidity run. The fact that we're trading with institutional sponsorship behind the move, and it's always going to be derived from the higher time frame. All right, so yes, your first chart here is a low resistance liquidity run setup on the basis that it is potentially making a run above this high here. Okay, so what you're looking for, low resistance, it's going to have very little difficulty getting above an old high because previous market action is indicating it wants to go higher. Okay, and I'm not going back and looking at any of the higher time frames, but from basically what you're looking at here, you're trading with internal range liquidity. What makes it internal range? From this low to this high, you're buying a retracement. And you're buying it without seeing that range be broken. And you're trading it under the context that it is a low resistance liquidity run for targeting. Okay, the low resistance liquidity run is defining how you profit from the position. Okay, internal range liquidity is the basis of which the setup forms. Okay, so there's two distinctions there. Internal range liquidity is where the trade forms, okay, and low resistance liquidity run is where the profit is realized, okay. Now, external range liquidity is what this is right here. It's outside the range. Now we went and made a higher high, so now we're outside the range. But it still is inside of the range from this high to this low. Or actually, this one here is a little bit lower. And I probably just scrambled your brain. You probably thought you were making making sense of what I was saying until I threw that in there. And that's what I'm referring to. You have to look at the higher time frame and see where you are in terms of the range, because price could very easily just poke itself above this old high here and then peter out over the bearish order block, and that's it. It doesn't go any higher than the previous high. So yes, this is a low resistance liquidity run, and it's based on the fact that you're trying to run the liquidity out above an old high using internal range liquidity as the basis for the setup. And let me go over to paint real quick, and I want to show you something. Okay, so on the left hand side we have the framework for internal range low resistance liquidity runs, which is a standard rally, retracement, and then looking for a move above the high that forms the retracement. Okay, so the liquidity resting above that high, that's what we're framing it on, and it is a low resistance liquidity run only on the basis that it's trading with higher time frame context. Now, it does not mean it's always linked to the daily chart. Okay, and it's, you can see the folks that I'm introducing, what has really been taught all through my tutorials. I taught the low resistance liquidity run without calling it that, without labeling it that, but everything in my free tutorials was all aiming at teaching the first low resistance liquidity run, which is running previous day's highs and lows. That idea only is true in the form that it's a low resistance liquidity run if a higher time frame than the one you're executing on. For instance, I'm giving you an example. Say you're looking at a 15-minute time frame, that you're looking at this potential scenario here. We have a rally here. We have a short-term high on the 15-minute chart. Then it retraces back down. Okay, classic, for instance, the New York setting. Okay, New York ICT kill zone retraces down past 8 o'clock in the morning to the 8:20 CME opening. And then boom, you expect to see the rally take place. Why? Because maybe the hourly chart, okay, is giving you a bullish scenario. It doesn't have to always be linked to a daily chart. It's better that your institutional order flow is arrived and determined by what you see at the daily chart. But if the daily chart is uncertain, doesn't mean you can't drop down to a lower time frame and scalp, but you have to use a higher time frame than one that you're using the execution on. So again, to frame low resistance liquidity runs is you have to know what the higher time frame the one you're trading in and seeing the entry on, you have to go to a higher time frame than that and see if it is bullish or bearish based on that time frame. If that's true and it's bullish, and we have this framework in here, we're